Hello everyone, welcome to day 2 webinar of ACCA Financial Management. First of all, I'm really sorry for the late start because of some technical glitch. We were not able to start the session. We have already wasted a lot of minutes, so really sorry for that. First of all, I will compensate that by taking the class 40 minutes later as well, which means I'll be completing my 3 hours for today. Thank you very much, guys, for joining this session. Kindly confirm, is my voice clear and audible to all of you in the chat box, please? Okay, thank you very much for the confirmation. Great. So, how to remain connected with me during the webinar? It's the chat box where you just have confirmed regarding the voice and the video. So you have to remain connected with me through this chat box. Number 2, this is my number. You can contact me, being principal of WIFI. For anything, you can contact me. I'll be more than happy to help you. Okay, great. So where I was, so you can contact me at this number for any help, support you want. I'll be more than happy to help you. For all the subject related issues, matters, you can be part of our paid groups. Here is the paid group. I'll just ask the team to just share the link in the yeah, you have that in the chat box. So you can just click and be part of the global groups where there is a global community of FM, all the notes, handouts, free resources, all I'll be sharing in these groups. But the paid students, obviously, you'll be getting everything on your paid portal as well. This is the support team number. Those who will watch this later on and wants to be part of the group, they can contact the support team at these numbers, and the support team will be more than happy to help you as well. All right. So I hope this is clear to all of you so far in relation to all these things. Let's move on. Revision camp. I've already announced that the revision camp has started on 6th of August. So all the self-study students who want to be part of the revision camp, they should be part of the revision camp because it includes important areas, pre-recorded content, the conceptual based videos, and the past paper practice sessions. Moreover, it includes 2 mocks where 1 mock will be a live mock, and we will also check and give you the feedback, and there will be a debrief live as well for this mock. Then there will be a grand revision part of this package as well, which is again very useful session. Moreover, there is another complimentary mock that you will have, and the debrief will be given to you in recorded form. So this is the plan for the revision students. Those who wants to join, they can be part of it. You are given with a proper plan to complete these pre-recorded content till the mock date of 23rd. Plus the webinar day 1 was on Wednesday. Today is day 2. Then you have your live revision session. Then there is a final mock to be held on 23rd with detailed debrief, 27th, result 28th, complimentary mock and debrief 29th and 30th. So this is the plan that you guys have to follow. Those who will join the revision batch, they will be given a separate planner to cover their pre-recorded content of important areas, which includes 20 to 35 important questions for exam. If you do those, you have a good chance to pass, and those will include that session. Revision camp includes the solution of that as well. So interested students can contact the support team still. It's valid. You can still grab it and take this opportunity and join the revision camp. All right, then. Today's topic includes very important working capital and business valuation. A lot of practice needs to be done today. So working capital is what we are starting first with. As you all know, working capital is very crucial for the success of any organization that wants to be successful in the long run. Their working capital management should be really good. So the first question that comes to our mind, the first question that comes to your mind, that should be coming to your mind, is what is working capital? What is the basic formula of working capital, which is current asset minus current liabilities? Current asset minus current liabilities equals to working capital, right? Remember, whenever you are doing a business, whatever project you opt for, there are two types of investment you make in the business. The first is the investment that you do in the assets of the of that particular project, like machine, plant, and everything. That is your long-term investment that you do. The other investment that you do is in the name of working capital as well, and this is the investment that you have to do in the business to ensure operations of business, right? Day-to-day expenses are met easily. Day-to-day problems are resolved on a timely basis. So you need to have that amount of liquidity in your hand, the amount of cash in your hand for day-to-day operations management, and this is your working capital. Working capital. So let's have a look. Working capital, which is current asset minus current liability. Why it is important for a business? First of all, it is very important to ensure that we strike a balance between liquidity and profitability. The objective of working capital management is to strike a balance between liquidity and profitability. It is very important for a business to understand that yes, they want they should be profitable. It is very important. They should be profitable. At the same time, they need to have sufficient cash in their pocket. They need to have liquidity in their pocket in order to run the business smoothly. So why I'm saying striking a balance is very important is that sometimes we give importance to one over the other. Like for example, if you are selling products at a credit, right? You are doing sales at a credit. So definitely more sales you expect, right? And if your sales goes up, uh, so definitely your profit will go up, right? So you are giving priority to your profit. On the other hand, the problem that this will create is it will reduce your liquidity because you are selling this at a credit and you are not getting any cash in your pocket, nothing. So your liquidity will go down, your receivables will go up, you will not have any cash in your pocket to pay out the day-to-day expenses that are important for your operations, like wages, salaries, maintenance expenses, and all, rental utilities, right? So this is not a good approach. So you need to strike a balance. You cannot compromise on liquidity to just grab or increase your profitability. On the other hand, there could be one more example where uh, where you may uh, be compromising on profitability at the expense of liquidity, and that is when you believe in cash sales, where you are like, we will not offer credit sales. Maybe your competitors in the market, maybe there is a norm in the market to sell the products at some credit, but you're not doing that. You are harsh, you are you are more like not compromising on policies. You are not giving customers any sort of flexibility, and you are only selling goods at cash. So this helps to improve your liquidity, obviously, because your cash sales will increase, you will get more cash. But what the problem this will create is your sales might go down. People who wants goods on credit, they are like, don't go to this XYZ company because they are not giving any sort of credit. We can get the same goods on credit from someone else. So this can have an impact on your sales, and hence the profitability will go down. So this is also not a good approach. That is why it is always say to create a balance between liquidity and profitability. You cannot give preference to any one over the other. Now the question is how to ensure that balance, how to ensure the objective of uh, uh, creating a balance between liquidity and profitability is created. So for that we need to manage the working capital properly, and for managing the working capital properly we need to first understand the individual components of working capital. Individual components of working capital means, as I said initially, this is basically a product of current asset minus current liability. So when I say what are the individual, when I say what are the individual, yes, let me ask my team to mute the student, please. Yes, I can see the disturbance as well. Let me ask the team to mute this student, Kolani Michael. Kolani Michael, if you can hear me, please kindly mute yourself. The team, kindly please, you mute Kolani Michael and allow people not to open their microphones, because this is creating a lot of disturbance again and again. Thank you. Okay. Now, coming back to where I was, individual component management is very important in working capital, my friends. So when I say current asset, so what comes to your mind is very simple. Inventory is the first important component for a manufacturing business. Followed by that is receivables, second very important component. Third, when I move towards current asset, we have cash. So you can see these three are part of your asset side, which are very important to be managed. Uh, uh, and this is what you need to ensure. So you have to manage inventory separately, you have to manage receivables separately, you have to manage cash separately. This is what we learn in working capital management. Moreover, when it comes to the liability side, there is also management required in terms of trade payables. Yes, I know, you know, payables is sort of a free source of finance, but it doesn't mean we should just squeeze the supplier. We should be totally, what I can say, we do not show any mercy to the supplier. That is wrong, right? So we need to make sure that the payables are managed properly, because we do not want to ruin our relationship with the supplier. Over On top of it, there is another very important thing that requires a management, and that is overdraft management. Yes, very crucial, very important. Overdraft is again taking short-term finance from the bank. It is very important that we respect the limit of the overdraft. We follow the rules of the overdraft, because excessive overdraft can kill the organization, because at the end of the day you need to pay a cost for it. Now for payable, in terms of financially, you don't have any cost as such, but for overdraft there is a direct financial cost that you have to bear, and that can hit the organization. So make sure that we do manage these properly, because excessive current liability uh, to finance current asset is dangerous for the business, as we'll see that later on. So now managing the individual components is very important, as I said earlier. Uh, what are the other ways to manage it? Definitely, there are different things that comes under inventory, like EOQ, in receivables, like having a good credit control policy. Uh, like cash, we cannot keep extra cash. We should not keep extra cash. We should properly invest it. Similarly, for payables, we cannot just increase the payables massively and ruin our relationship with the supplier. Similarly, for overdraft as well, we need to ensure that we do not exceed the overdraft limit. We need to manage overdraft as well. So this is also very important. So what I'm trying to explain you here is individual components management is very, very, very important at all the levels. But on top of it, there are certain ratios that do help us manage these things properly. And when I say ratios, so what are the ratios that are important for us to calculate for the management of them? So that includes, number one, current ratio, a ratio that basically indicates the liquidity of the organization. It indicates that how much of current asset you have in order to cover your liabilities. Similarly, you have another ratio by the name of a quick ratio, or we can even call this as asset test ratio, a ratio which says that other than inventory, how much current asset the business has in order to pay off its liability, right? In order to pay off its liability. So that is asset test ratio or quick ratio. Then we have third one by the name of working capital turnover ratio, and this is a one uh, that we work out by using the formula of sales divided by working capital. And this working capital turnover ratio indicates us, it tells us that how that $1 of working capital, how much is generating sales, which means we are using our working capital. So how much $1 of working capital is being used in the generation of sales. So this is also a good measure to gauge liquidity. Then there is another group by the name of operating cycle ratios that deals with the inventory days, that deals with receivable days, that deals with payable days. And if it's a if it's a manufacturing business, so this inventory is further divided into raw material days, WIP days, and finished goods days. Okay, so calculating all these days do give us the idea in do give us the idea that for how many days our cash is stuck in raw material, in WIP, in finished goods, in receivables, and how many days we take to pay our suppliers. So using all those days information, we can work out the cash operating cycle known as COC, which basically indicates the amount of days our cash is in this cycle, the amount of days our cash is stuck in the cycle. And you have to keep this in your mind. The more the COC, the more the cash operating cycle you have, the more will be your finance cost. The more the days of COC, which means the more your cash is tied up into this cycle, and this is something which can create working capital problem for you, because more receivables means more cash is stuck, more inventory means more cash is stuck. So more the days of COC, the more working capital is stuck into this cycle, and more finance cost is needed. Sorry, more finance is needed. This will result in more finance cost. So this is how we get the position of working capital. This is how we understand the company's liquidity position, how good the company is going, how bad the company is going, using these ratios, which can help us in the management of working capital. Through this, we can basically take actions in order to, for example, reduce the inventory days, reduce the receivable days, something like that. We can come up with different strategies to improve our working capital. Plus plus uh, through these you can also identify two major issues that the business might face, and those problems are known as over trading problem, and second is over capitalization problem. So these ratios are also useful in identification of the two major issues that business might be facing, and that, as I said, is over trading and over capitalization. Over trading means the business is increasing its sales at a very higher pace, growing the sales at a very higher pace without proper support of working capital, without proper support of long term finance to support that over trading, right? Similarly, overcapitalization is a situation. This means that the business is investing too much in its current asset, has invested too much in its current asset, and definitely this is a situation where the company has invested too much in its current asset and not utilizing its asset properly. Okay, so overcapitalization, overtrading are two different problems that the business might be into. In case of overtrading, the company might be using too much of short-term finance, and there is lack of long-term finance to support the business operations. Too much short-term finance is part of the system, whereas there is a massive lack of long-term finance. Similarly, in case of overcapitalization, the company has invested too much of their own finance into the assets, in the current assets, and not using short-term finance too much. In fact, their own cash is very much stuck into the business. So yes, it is very important to identify these problems. Let's now dive into one of the major issues by the name of overtrading. Overtrading. Okay. Now, overtrading basically is a situation, as I mentioned earlier, that this is a situation where the business is increasing its sales, the business is doing large volume of trade of using small working capital. The working capital is not enough to support the large business sales volume. Okay, which means the company is not investing too much in the working capital. There is a lack of long-term finance. Company is not investing using their equity or long-term debt to keep a good sustainable investment in working capital. Okay, so basically this is a situation where the business is increasing its sales without a proper support of working capital. Okay, now now if you see here, uh, if you are not investing into the business in periods of growth, now when you are growing the business, when you are increasing your sales, and how you increase your sales, for example, you start selling the goods on a huge credit, right, in order to promote the sales. Now if sales is going up, so your receivables are going up by a good amount, your inventory holding should also go up. Obviously you need more and more inventory again and again. So at the same time, if you don't invest into the business as a owner, if you if you, for example, are not investing in the business and you are not bringing more equity into the business, or you're not using long-term source of finance into the business to sustain such growth, then eventually you have to move towards short-term source of finance. You unintentionally or intentionally will be using your short-term source of finance more, like your payables. You will not be paying suppliers on time, like you will be taking a lot of overdraft as well. And this means that you are using short-term source of finance a lot instead of long-term source of finance to support the sales growth, to support the expansion of the business. Moreover, there is one more thing that is coming to my mind, that when you increase the sales, maybe you need more you need more non-current assets as well. Your non-current asset ratio also go up. You have to buy some machinery and all as well. So now again, that is a long-term source of finance that is needed in order to help or match the non-current assets. If you don't have that long-term source of finance, and this means you'll be using your short-term source of finance for even matching your non-current assets or long-term investments, that will definitely be very, 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 very dangerous for the business. Okay, so that's why long-term finance increase is very important to support the growth of the business. So if you want to check whether a business is over trading or not, guys, are you with me? Say yes or no. If you want to check, if you want to check if the business is over trading or not. So very simple, you can check that, and there are certain signs I'm telling you. Just remember these signs. Number one, you have to check whether there is a drastic increase in sales revenue. You have to check whether there is an increase in account there's an increase in inventory days? Is there an increase in receivables? Similarly, is there an increase in payables, bank overdrafts? Okay, is there a fall in current and quick ratios? And is the profitability of the business going down? So these are the certain signs of over trading. And if these signs are obvious, the business is moving towards over trading. Now, my friends, please be with me and answer me. Do you want to become a PhD, or do you want to become a doctor in case of over trading? Say yes or no. Do you want to know? Do you want to figure out how easily, quickly you can figure out whether business is over trading or not? So, do you want me? Do you want to make this easy for you? Yes or no? What is your response? Everyone, please, I need your answers. So I'll be making you the PhD, I'll be making you doctor uh, in overtrading. You will be specializing in overtrading right now. I'll tell you certain very easy things, very simple things in order to check whether the business is overtrading or not. So there are whenever you go to a doctor, what happens? Tell me. Whenever you go to a doctor, what happens? When you go to the doctor, you tell the symptoms, you tell the problems. So what doctor does? Doctor will look at the signs of those disease in you, right? They will look at the signs, and if uh, they think, yeah, there could be a possibility of the disease, what they do, they ask you to do certain types of blood tests. Remember, they ask you to do certain type of tests, like do your what I'll say, culture report, for example, blood report, blood sample. They ask you to take and just get it checked by some proper laboratory and all. So they ask you to conduct certain tests, and based on the results of test, they come to a conclusion whether you are suffering with that particular disease or not. Are you suffering with the particular disease or not? Are you with me, everyone? Say yes or no. So this means, if that is the case, to check these signs, we will be doing type of certain type of uh, test, and this test will make you the doctor. This test will give you the clarity. This test will make your life simple. This test will help you to solve the case of overtrading very, 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 very easily. Very easily. And I'll tell you certain tests that will help you to figure out that whether the business is suffering from overtrading or not. So generally, there are certain number of tests that we ask the client to do, and once they do, they get to know. So what are those? Let me just tell you. Let me just tell you. Let me just connect with these signs for better clarity. Okay, and let's start. Number one. Number one, in order to check, please be with me, everyone. Okay. In order to check whether there has been a drastic increase in sales revenue or not. So what we do, what test is recommended? So the first test is percentage increase in sales. Percentage increase in sales. Okay. Number two, what else can I work out here? Percentage increase or change in working capital. Number three, what I can work out? Working capital, working capital turnover ratio. Working capital turnover ratio. Guys, you need to uh, just keep this in your mind. If you want, you can copy this as well. Working capital turnover ratio. Okay, so these are the three ratios that will be useful in concluding whether there has been a drastic increase in sales without the support of working capital. I repeat, whether there has been a drastic increase in sales without the support of working capital. Number two, for inventory, you can work out percentage increase in inventory and number of inventory days. For receivables, percentage increase in receivables. Are you with me? And number of receivable days. Okay. For checking whether the company is financing its asset and sales in form of accounts payable and bank overdraft. So you can calculate here, number one, percentage increase in payables. Number two, you can work out payable days. Number three, you can work out percentage increase in overdraft. Okay. Plus, you can work out percentage change in non-current assets. This also gives you the idea that how much of non-current assets has gone up for the business. Okay. You can even calculate percentage change in long term finance, like in form of equity or maybe long term loans. This all helps you to come up to the conclusion what sort of changes are happening in the business. Then for current and quick ratio, you can work out current ratio, you can work out quick ratio, you can work out current ratio, you can work out quick ratio, and all this will give you the idea about the dramatic fall in current and quick ratio. For decrease in profitability, you can work out percentage profit margins. Okay. Now, so these are the one, depending on the situation, depending on the data that is available. This is a very good list that you have to keep in your mind in order to check over trading. So if I say percentage in increase in sales, working capital turnover ratio will be useful to check whether sales increase is with proper support of working capital or not. For inventory, you can work out these two things. For receivable, you can work out these two things. For payable, you can work out payable related two things. Then for overdraft, then you can even work out percent increase in non-current asset to see how much increase is in the non-current assets, how much increase is in the long-term finance if required, and then current ratio, quick ratio, and percentage profit margins. So these are the ratios that helps you to come to certain conclusions, and based on the results of these ratios, you conclude whether business is over trading or not. Are you all with me? Say yes or no, everyone. Is this clear to all of you? Yes or no? Okay, that's great. That's really nice. That's really good. Okay, so yes, these are the things that one needs to keep in mind. Just note down, make a list, and whatever mainly is possible, considering the exam question, the data available, work out that. Based on the results of these blood test, CBC results, culture results, we will comment, we will say that yes, the business is overtrading or the business is not overtrading. Okay, great. So I hope this is clear to all of you. Just keep this in your mind. As we move towards the question, you need to be able to figure out these things. Done. So a business might be overtrading, a business might not be overtrading. It all depends. The business might be under a problem of overcapitalization or might not be there. So you need to check that as well. As I mentioned initially, it is very important that whatever you do, whatever management you do, it is important to strike a balance between liquidity and profitability. Liquidity and profitability. So to ensure that there are certain working capital policies, there are certain important working capital policies. The first policy is known as working capital investment policy. I repeat, working capital investment policy. Now, working capital investment policy deals with what? Deals with what? So, investment policy deals with how much investment needs to be done. How much investment needs to be done in your current assets. Okay, investment needs to be done in your current assets. So the level of investment that you have to do in the current assets, the level of investment that you have to do in the current asset could have aggressive approach, could have conservative approach, could have a moderate approach. Okay, so basically investment could be based on aggressive policy, conservative policy, moderate policy. Are you with me? So working capital policy number one is investment policy, which says how much to invest in working capital. And for that, there are three approaches: aggressive approach, conservative approach, moderate approach. When I say aggressive approach, what is that? Can you guys tell me what is working capital aggressive investment policy? Yes, Mohammed, you are right. We can even call this as undercapitalization. Overtrading is undercapitalization. Okay. So, in case of investment policy being aggressive means you are making less investment in current assets. Less investment in current assets. Okay. Whereas in case of conservative policy, you are investing too much in current assets. Investing too much in current assets. Okay. And as per moderate policy, it's a balance of investment. Balance of investment. Okay. Similarly, then comes policy number two, which is financing policy. Working capital financing policy, which is about how much to finance in the name of working capital. Sorry, I beg your pardon. Financing working capital policy deals with from where to finance, from where to finance, from where to finance. So it's very simple. Working capital investment policy, working capital investment policy deals with how much to invest, how much to invest. Should we invest more? Should we invest less? If I invest more, it's a conservative policy. If I invest less, it's an aggressive policy. Similarly, the second question is, okay, clear, we know how much to invest. We are clear, we know how much to invest. The other question is, from where to finance? From where to finance? So the answer is conservative policy here you have to apply, moderate policy here you have to apply, or aggressive policy you have to apply. So again in financing working capital policy, again you have three approaches. Same three approaches here as well. aggressive, conservative, and moderate. But in case of working capital financing policy, it is important to determine, it is important to bifurcate between non-current assets and current assets. Non-current assets and current assets. So the question is, non-current assets are non-current assets. Everybody knows about non-current assets. In case of current assets, there is a bifurcation between two. One is permanent current assets, second is fluctuating current assets. Both are current assets. Now, when I say permanent current asset, what it means? Those inventory levels like buffer, like minimum receivables, like minimum cash balance, these are permanent current asset, which means they remain same throughout the year, same throughout the year, same throughout the year, like buffer stock. So you need to finance that permanent current asset throughout the year. Then comes fluctuating current assets, are those current assets that will fluctuate as per the seasonal requirements. You might have to increase more, you might go down because of the drop in the season. So that is fluctuating current asset, which means inventory above than the buffered stock that might go up due to high peak season, that might come down due to less season. So this is fluctuating current asset, which again will vary according to the season. So here in case of financing policy, it is important to determine between these two and then decide whether we have to go towards short-term finance option, long-term finance option. Short-term financing is low cost in terms of interest rate as well. The cost for the business is low because whatever overdraft amount you have, you pay interest on that. Because it is short term, so the bank might charge a lower interest rate because bank cash will not be stuck into the business for a higher time period. But it is highly risky. Highly risky. Why? 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 Overdraft, rate risk, renewal risk. Bank might not give you the overdraft again. Bank can ask you to repay the amount then and there, immediately, whatever the case is. So this creates a lot of risk for your business. Lot of liquidity issues can come because of this overdraft thing, because of this short-term finance. On the other hand, long-term source of finance is high cost. Yes, the interest rate that the bank normally charges is a higher rate because their cash will stuck for a longer time period, longer time period, longer time period. Plus, if you go with equity, for example, so cost of equity is also expensive. Everybody knows about it. Cost of equity is more, is expensive. We know about this. So it's a high cost thing, but the risk is low, which means no on-demand repayment, no on-demand repayment, no rate risk, no renewal risk. You have the loan for a longer time period. You have equity till the end. You can easily use them to finance your working capital. Working capital. So the risk is low. So now you need to strike a balance. You need to see which is the best approach. So the aggressive approach of financing says what? The aggressive approach of financing says what? It says that we will be investing our will be investing all the fluctuating and major permanent through short-term source of finance. This is bad. This will be a higher risk option, but the cost would be low. High risk option, but the cost would be low. High risk option, but the cost would be low. But this will ultimately do what? This will increase your profitability. This will increase your profitability because the cost is down, profit will increase. But this can have an impact on liquidity. This can have an impact on liquidity. Your liquidity might not be good. Maybe bank will ask you, come on, I need my amount tomorrow. If you repay them, you might be into a massive cash crunch situation. So this is not the balance. Then comes conservative policy, which says that all the permanent and most of the fluctuating will be invested through long-term source of finance. Long-term source of finance, which means that your cost would go up, but the risk is less. Your liquidity position will not be that bad in that case. So what this will do? This will reduce the profitability, but will make your liquidity better. Liquidity better. Liquidity better. So my friends, what is the last approach? Matching approach, moderate approach, matching approach, moderate approach, which says that you tell me what should be the best approach. You tell me what should be the best approach. You tell me what is the matching approach. The matching approach is, come on guys, where are you? The matching approach is what? The matching approach is what? No response at all. Awesome. Great. Nobody knows what is the matching approach. The matching approach is that we invest in permanent current assets using long term, fluctuating using short term, permanent using long term, fluctuating using short term, permanent using long term, fluctuating using short term. Yes, because what this will do, this will create a balance between cost and risk, cost and risk, cost and risk, and hence a balance between liquidity and profitability. Liquidity and profitability. So this will give you the balance between liquidity and profitability, and this was the initial objective of working capital management. Perfect, perfect, perfect. Guys, how was the revision? Liked it? Yes or no? Were you able to recall things? Yes or no? Great. So now it's time to start with our first question for today, and that is CRQ. CRQ. Let's begin with the first question for today, and that is CRQ. Before I get into the details of CRQ, I just want to give you a basic clarity about the CRQ questions, and those includes whenever you are reading the CRQ question, the first thing to check is whether the question is knowledge based, or the question is application based. Okay. Now, knowledge based means simple, bookish theory is what you have to write. Bookish theory. Whereas in terms of application based, you have to link the knowledge with scenario. Okay, with the scenario. You have to link that. So you have to figure out whether the theory that you are writing, that you are planning to write, is a knowledge-based theory or it's an application-based theory. How to determine, how to figure out? So it's simple. They do ask in the question by taking the name of the company. They say, for example, for XYZ company, tell us this. For YZM company, tell us this. For Gorva company, tell us this. For ESCO, tell us this. This is one where you have to link with the scenario most of the times. But when they are generally not using the name of the scenario, for example, asking you advantages of NPV without linking, without saying the name of the scenario, it's more of the time towards the knowledge-based side. So my friends, both types of theories are tested in your examination. And today, maybe if I have the time, I will share a very good document with you people that I give to my paid students. I'll show you how I prepare my students for knowledge and application based stuff, how I have segregated so many attempts questions into knowledge and application based. I might show that to you today, but it's very simple to figure it out. Knowledge based, bookish theory, no linking required. Application based, link with the scenario. The first thing that you have to see while reading the question is to figure out knowledge based, application based. Second thing that you have to see and figure out is the verbs, the objects, and the word and is what you have to see. Now, verbs like evaluate, discuss, explain, I told you that these are very important. You should know the meaning of these verbs because verb actually indicates the action that you have to perform. In how much detail you have to go into. Like state, less detail. Explain, more detail. Then you have to see that this action is required to be performed on what? On what? What is the element on what you have to perform the action? Okay. So you have to see this, like advantages. Are they asking for? Explain the advantages. So advantages is the object. Explain the drawbacks. So drawbacks will be the object. So to see on which thing you have to perform this verb or action. The word and is important as it gives you the idea about the additional requirements. Additional requirements. It gives you the idea about additional requirements in a question. Okay? Additional requirements in a question. This means what additionally they have asked you to answer. Okay? So there could be more than one requirement. There could be more than one requirement, more than one object, more than one verb in a single requirement. More than one object, more than one verb in a single requirement that you have to figure out, because to get the marks, to get the complete marks, you have to answer all requirements. Answer all requirements. Okay, that's why it was segregated. So in CRQs, the narrative side especially, you have to look at this and this while solving the question. These were the tips for CRQs that I was giving you for today. and these tips will make your life easier. Make sure you complete the CRQ within 36 minutes. 36 minutes as per the marking scheme. It's now time to move towards the CRQ. So here we are. Whenever we start with CRQs, we always read the requirements to determine these things, like what verbs, what objects, knowledge base, application base, and marks. Using suitable working capital ratios. Suitable, you decide the suitable ones. And analysis of the financial information provided. The ratios and the analysis of the financial information provided. Okay? Use the ratios and the analysis. Evaluate is the examinable verb. Evaluate means to judge. Evaluate means to find out the positives, negatives, and give a judgment. Give a judgment whether G company can be described as overtrading. Can be described as overtrading. So this is what you have to figure out. This is what you have to figure out. So the verb is evaluate. Evaluate. The object is company overtrading or not? Overtrading or not? Done? 6 marks for calcs. 6 marks for calcs and 12 marks for 6 marks for calcs and 6 marks for the theory that you will write, the analysis that you will do. So this is what you have to see. This is a 12-mark requirement, 6 marks for calc, 6 marks for theory. Clear? Very nice. Done. The next part. The next part. Video dekh. The next part. Explain, examinable verb. Explain, examinable verb. What advantages and disadvantages. Advantages and disadvantages of conservative approach. Okay, listen. Interesting. Conservative approach as compared to aggressive approach of what? Financing. So this is not an investment policy. It's a financing policy. It's a financing policy. It's not an investment policy. Okay. So explain the advantages and disadvantages of conservative approach. To the financing of G company's working capital requirement, which means scenario based. Scenario based answer is what you have to come up with for 8 marks. It seems to be an application based question. Correct? Application based question. G company name is being used, so you have to answer keeping in mind G company. Clear, everyone? Say yes or no. Done. So verb objects, khalas. Knowledge based, application based. Knowledge based, application based. Application based. Okay. Part 1. Again, knowledge based, application based, purely application based. For G company, you have to determine whether it is overtrading or not. So you are the PhDs, you are the doctors of that. You You have a client in front of you, and the client is G company. You are the doctor. He is in front of you, and you have to determine whether he is into a disease of overtrading or not. So what will you do? You know the signs of overtrading. What are the signs of overtrading? You know the signs of overtrading. What are the signs of overtrading? Drastic increase in revenue, increase in inventory and receivables, increase in payables and overdraft, uh, payable and overdraft for the financing purpose, decrease in current and quick ratios, decrease in profitabilities, and all these signs, if after doing the test, are in favor of overtrading. So you'll say, yes, you are facing a disease of overtrading. So let's see, guys, by looking at their financial information. Here we are. The financial information relates to G company. G company, okay? Statement of profit or loss extract are available. You can see you are given with revenue, cost of sales, PBIT, interest, profit before tax, taxation, profit after tax. Okay. Statement of financial position includes non-current assets, inventory, receivables, cash, payables, overdraft. Correct. Then you can see here you have equity sides, equity, reserves, loan notes, and liabilities. All sales are made on credit, and the company operates 365 days a year. Now listen, my friends, because you are the doctor, the first thing, if you look at their financial statement, see what I'm doing. See what I'm doing. See what I'm doing. See what I'm concluding in my mind. Are you with me? Say yes or no. So what I'm doing here first, I'm just looking at the numbers. I'm just observing the numbers. 900 sales went to 1530. There is an increase in sales. This means business is growing, expanding. Okay. Okay. The profit, the profit, the profit has also gone up. Whether it is PBIT, profit before tax, or profit after tax, all has gone up. Okay, the profits have gone up. I can see the PBIT increase as well. The profits have gone up. Okay. Now, non-current asset. This means there has been investment in non-current assets. There has been investment in non-current assets. Are you with me? Are you with me? Yes or no? There has been investment in non-current assets, which gives the idea that to support the expansion, the growth, you have invested in non-current asset, and that is important. Maybe in form of machinery and all you might need. I don't know what kind of business they do, but yeah, it seems okay. Inventory gone up, receivables gone up, cash nil, from 44 0. Remember, they are increasing the sales. Their business has gone up. Remember, their business has gone up. Their profits have gone up. Their profits have gone up. Their business has gone up. Where is cash? Payables gone up, which means you're spending your cash, and you even have to take overdraft. So from a cash surplus position to cash deficit, now you are. Remember, your business is going up. Your business is going up. When the doctor talks to the client, initially they say, I think this is a problem, but I need to check this infection. I think there is an infection. I need to check the infection. I think this is a disease. I need to check the disease. your symptoms are not good. Let's say your symptoms are not good. Okay, so you don't have any cash now. Any equity raised? No long-term finance through equity. Your reserves have gone up. Your reserves might have gone up. Your reserves have gone up. Yeah. And this could be due to your profits. Your profits. Yes. Your profits. No long-term liability raised, which means no equity, no long-term loans, no equity, no long-term loans. Yeah, reserves have slightly gone up. Reserves have slightly gone up. Maybe your profits, retained profits is what you might be using, something like that. But there's no proper investment. There's no proper long-term investment done to support the expansion. And as you are selling everything on credit, so you are giving credit to promote the sales, you are expanding your business, you are expanding your business, you are expanding your business. Yes. You are cash rich? No. Any long-term investments done mainly through equity or long-term loans? No. There is a massive, massive possibility of over trading. Over trading. But the doctor will say, I'll not conclude right now. I'll not conclude right now. I will do certain tests. And the tests are the calculations. Okay, man. So the tests are, let's begin. Certain tests we need to do, certain calculations to be performed. Guys, are you with me? 2007. I don't know, it's 2000 or 2x 20x7. Okay, so 20x7, 20x6. The test, the doctor is giving the test. What test to do? Let's see. I know drastic increase in sales. I'll work out percentage change in revenue. I'll just make a plan for myself. I'll work out percentage change in overdraft. Okay. But here, last year there was no OD. Last year we were in cash rich position. Now we are into overdraft. So precisely I cannot work out percentage change in OD. So let's leave it. I'll use absolute figures. Then working capital turnover ratio. Then guys, are you with me? Yes. Then I'll work out percentage change in inventory. Come on, be with me, please. Inventory days, percentage change in receivables, receivable days, percentage change in payables, payable days. Okay, one thing that I forgot was change in working capital. Yeah, this is what I need to work out here. Sorry, working capital. Be with me, everyone. Okay, then I'll not work out percentage change in OD, but I'll comment on that, and I can work out for long-term financing. The only thing I see here for long-term financing, the only thing that I see here is no equity, no loans, so reserves. Yeah, so I can say percentage change in reserves for long-term financing. Okay, right? And then current ratio, asset test ratio, and operating profit margin. Approximately 12 to 13 ratios. 12 to 13 ratios, okay? I've added one more here, like operating profit margin. So 12 to 13 ratios, depending on the situation. Now, let's do the calcs quickly for 6 marks. Let's do the calcs quickly for 6 marks. Oh, man. You will be getting approximately 0.5 marks for the calc of per area. Now, change in revenue. Do the calculation in the cell. No need to write the formulas. 1530 minus 900 divide by 900. Okay. Working capital turnover ratio. What is the formula, guys? Sales 1530 divided by working capital. What is working capital? Current assets minus current liabilities. 359 minus 154. Okay. Last year, you can even work out this for last year, but obviously percentage change is something you cannot work out. 214 minus 63. Guys, everyone be with me. I hope this is very much clear to all of you. Right? Change in working capital, I can work out that as well. For that, I need to find out the working capital amount. That I can do. I can show you as well. Working capital for 220x7, 359 minus 154 is 205. 205. Okay. Second, 214 minus 63 is 151. So remember these two things. 205, 151. Okay. 205 minus 151 divide by 151. Correct. These are the one that I can show in form of percentages. These are the one that I can show in form of percentages. This is what I can show in percentages, okay? Done. This is in times. This is in percentage. Correct, everyone? Yes or no? Percentage change in inventory. Simple, quick calculations you guys can do. 107 divided by 107 minus 59 divided by 59. Inventory days. 107. What is the formula of inventory days, guys? Inventory divided by cost of sales. Yes. 1300 into 365. 30. Receivables. 252 minus 111 divide by 111. Wow, 127%. Are you out of your world? Receivable days, 252 divided by credit sales, 1530 into 365. The previous year I am writing directly, but you have to show the working, okay? Percentage changes you cannot work out for 2 years because of the limited data. I hope it's clear to all of you. Done. Change in payables. Again, cost of sales is what I'll use here, okay? So it's like 143 minus 63 divided by 63. Wow. Payable days, 143 divided by cost of sales of 1300, I think, into 365. Okay, the previous was 32. Percentage change in reserves. Here it is. To identify the long-term finance you are building into the business to support the business operations. I think I need to use brackets here. All right. Understood? Clear? With me? See, this is the amount of time it will take. Current ratio, formula current assets 359 divided by current liability 154, 2.33. The previous is 3.4. Asset test ratio 252 divided by 154 is 1.64. Previous 2.46. Okay. Operating profit margin. 230 divided by 1530, 15%. Last year it's 180 divided by 900, 20%. 6 marks in the pocket. 6 marks in the pocket. Easy 6 numbers in the pocket. Done. Khalas. 12 to 13 ratios. 12 to 13 ratios. Correct, everyone? But yes, write, calculate approximately 0.5 to 1 mark. Okay, 0.5 to 1 mark. 0.5 you can see here. Because it says 6 marks, so 0.5. Right? So, done. Now comes the part of discussion. And here there is no word processor. So we have to draft it on the Excel. I'll use certain headings. First, overtrading. What is overtrading? This is what I'll start first with. A brief definition will give me easy numbers, easy numbers, easy numbers. Okay? And one thing also comes to my mind, because I've worked out the days, I can work out cash operating cycle as well. I have the days with me now. Okay? So like inventory days plus receivable days less payable days will give you COC, 50 days. This is in days, right? The same I can work out for 43 days. Done. Now, I'll be using all these things in my interpretation. Okay? So, overtrading is what I'll start first with. Then, I'll talk about drastic increase in sales, second heading. Then I'll talk about increase in inventory and receivables, because this is what I'll be testing here. Then increase in payables and overdraft. Okay? And other factors. Okay? Current and quick ratio and profitability. Conclusion. See, I am making things more simple, achievable for you people. Use of headings is not prohibited at all in the examination. So under these headings, I will draft my answer. I will draft my answer. That will make your life super, super easy. One easy mark you want? One easy mark you want? Say yes or no. Just define what is overtrading. or undercapitalization? One easy mark in your this pocket. Okay, let's begin. What is overtrading? Overtrading occurs when a business is expanding, okay, and increasing its sales without proper without proper input of long term capital. Okay, the business doesn't support working capital in order to match the sales, right? So if your long term capital will not be invested to support your working capital, you will suffer, right? So 1 mark, easy. See, this is a paragraph. Once I'll click the button, this will not be visible, I think. Yeah, this will go into this cell. So this is what I've written here. I don't know why they use spreadsheet for this question. It should have been on a word processing sheet. I think that would have been better. Anyways, it's their choice. Done? Khalas? Done. So 1 mark done. Second, drastic increase in sales. What to comment? So let's use the ratios. Okay. The sales of G company has gone up by a drastic 70%. Is that true? Yeah. 70%. Yeah, 70%. Drastic 70%. Okay. However, the working capital increase is just by how much? How much? Guys, 36%. Are you with me? Come on. Where are you all? 36%. Okay. Indicating lack of working capital for sales growth. Okay. Now, this, okay, the working capital turnover ratio indicates an increase Okay, from where to where? From 5.9 times, 5.9 times to 7.5 times. Are you with me? From 5.96 times to 7.46 times. Is that right, everyone? Yes or no? Reflecting the strain on working capital for the generation of sales. Done. Can you see how I'm using these things? Say yes or no. See, you can see here in the paragraph form the way I'm writing it. Okay, done. Next, let's comment. Let's see the comment. Okay, I can even add one more thing. Also, an increase. Okay, I'll use this later on maybe. Yeah, done. Now, increase in inventory and receivables. So let's see, guys. The increase in inventory is by 81%, receivable by 127%. Wow. In which part of the world are you living that your receivables and your inventory is increasing more than your revenue? More than your revenue. So don't you think this will put strain on working capital? Don't you think this will affect the COC? Don't you think it will create problem for the business liquidity? Yes, it will. So I'll mention the percentage increase in inventory okay the percentage increase in inventory and receivables is by 81% and 127% respectively, which is much higher than increase in revenue. It's wise to compare with revenue increase, okay, of 70%, indicating adverse impact on working capital. Okay? On liquidity, I can say. Yeah. This is further indicated by looking at the increase in inventory days by how many days the inventory has gone up? Yes, friends. Oh, inventory days remained constant. Okay. Whereas receivable days have gone up by 15. Inventory days remained constant. So I'll just mention then about in receivable days by 15. Okay, everyone, clear? Done? So you can see how we are using all this. Come on, this is how much you have to write in the paper. Honestly speaking, you actually what is needed. You don't have to tell percentage changes that has happened. You have to tell mainly that this percentage change is resulting in what. So as I mentioned, this is affecting the liquidity. In the above point, I mentioned that this affected working capital. So you have to basically mention the reason, mention what this change will bring impact onto. You cannot simply just mention percentage change, this went up, this went down, this went up, this went down. No, that's not sufficient. You have to mention because of the change, what is happening, what the result is. This is what is required. I cannot do anything about it. Done? Clear? Are you with me? See, headings are not important, as I again will repeat here. If you don't want, don't write the headings. Khalas. Write in different paragraphs. That is important. Write in different paragraphs. Why I'm making headings is for your own ease, so that you don't miss out on anything. Okay? Headings are not important here. You can write in form of paragraphs, but what is my work then? My work is to make your work simple. That is why I'm categorizing into different areas so that you don't miss out anything. Clear? Understood? Okay. I think let's take a break now. We'll continue with this. Let's refresh ourselves. Let's take a small break. We'll come back. We'll solve this. We'll move to the next area and further things that we will do. Right? Let's take a short break. See you after the break. All right, guys. Now, let's look at increase in payables, OD, and other factors, which is a very important discussion that I'm doing. I'll be covering I'll be covering a lot of important things here. So you can see, you can see here, uh, the payables have gone up by 127%. Okay, so that's a massive increase. The increase in payables is by 127%, much more than increase in revenue. Also, the cash surplus of 44 cash surplus of 44 has now been converted into overdraft of 11, indicating negative cash balance by 55. Is that right, everyone? 11 and 44 is how much? 55? Hello? 11, you were at 44 positive, that completely vanished, and 11 is the overdraft now. 55. Okay? This indicates more use of short term finance to support increase investment in inventories and receivables. Is that correct, everyone? Yes or no? Okay. However, the long term however there has been increase in retained reserves by, how much was the increase in reserves? 65%. Okay, increase in reserves by 65% with no other increase in equity and long-term debt finance. This indicates clearly that there has been more use of short-term finance to support inventory and inventory, receivables, and non-current. Now there's an increase in non-current asset as well, okay? Non-current asset increase compared to long-term finance, which was in form of reserves only. Okay, so you can see what all I've covered here by mentioning that there has been increase in inventory by 81%. Listen please. There has been increase in receivables by 127%. Okay. All this investment increase was mainly financed by short-term source of finance through payables, through overdraft, through payables, through cash and overdraft, with very less use of long-term source of finance in form of new equity. There was no new loan, long-term loan, there was no, except there has just been an increase in reserve by 65%. That's it. Okay? Clear? Done? So all these things are clearly giving us the idea that there has been a massive more use of short-term finance instead of long-term sources of finance. This paragraph completely gives you the idea about the coverage of payable, OD, long-term source of finance to finance inventories and receivables. Hello? With me, everyone? Done. Current ratio and quick ratio both have decreased. You can see here, both have decreased. Is this true? Yes. From 3.4 to 2.3, from 2.46 to 1.6. With current ratio dropping from how much, guys? 3.4 to 2.3, and quick ratio from 2.4 to 1.6, indicating decline in liquidity position of the company. Okay. Now, yes, we need some, I don't know, we need some comparatives to see whether this level is okay or not, but there has been a decrease. There has been a decrease. However, industry average will be useful to comment whether this level is acceptable or not. Because 2.4 in isolation is a good one. 1.6, sorry, in isolation 1.6 is good. 2.3 is good. But I don't know whether what is the industry practice. However, there is a decline, and the decline is something that is alarming for me. Okay. Lastly, the operating profit has also gone down from 20% to 15%. Okay. Further indicating that there will be lack of retained profits to support expansion. Obviously, if your profits go down, your retained earnings will go down. I'm not saying in absolute term it did went up, but what you could have saved more, now you have less to support the operations. Okay. So I hope this is clear. Conclusion, considering increase in COC and more use of short term considering increase in cash operating cycle, which impacted liquidity of the company along there are obvious signs of overtrading done by Gro as indicated above by different ratios. Okay? Clear, everyone? Yes or no? Done. So there are so many things that we saw above, the signs of overtrading. Clear? Abdul Wase, cash operating cycle, if it increases, it's mean that your cash is stuck more in the entire cycle. This means it requires financing. It creates liquidity crunch for you. Okay? I'll just rephrase this a bit. Other obvious, just wait. Okay, now this is a well drafted conclusion covering all the ratios above. Okay, plus considering that liquidity position is not good and it seems that it is experiencing a problem over trading. Okay, done. So if you will not take any corrective action soon, the company will be in a bad position. Clear, everyone? Done. Now this was the answer. Overtrading paragraph, definition about sales increase, inventory impact, payable signs, use of more short-term finance, quick ratio, current ratio dropping, profitability going down, affecting the reserves, retained earnings, and the conclusion. Done, everyone? Say yes or no. Clear? Understood? Okay? So remember, never just write about percentage changes. Always mention that this increase or decrease, what impact it will eventually have on the liquidity of the company. Okay? Done. So as a doctor, to check the signs, you need to do test. You need to perform test, approximately 12 tests, and then discuss the results of those tests, that how are they impacting the company's liquidity position, and if they are impacting adversely, so this is a sign of overtrading. Clear? Next, explain advantage and disadvantages of conservative approach compared to what? Compared to what? Aggressive approach. Okay? Compared to what? Aggressive approach to financing working capital requirements of GE Co. Now, one thing is for sure, that G company, if I ask you after such a detailed discussion, G company is using short-term finance more or long-term finance more? Tell me. Short-term finance more or long-term finance more? Short-term finance more. Clear? Now, 6 marks, 8 mark requirement. Easy numbers you need. Easy numbers first. Quickly define conservative policy, 1 mark. Aggressive policy, 1 mark. Out of 8, 2 simple easy marks. Let's grab it first. An aggressive approach to financing means all of the fluctuating current assets and part of permanent current assets are financed through short term. Are you with me? Yes or no? Short term finance. Okay? 1 mark. Whereas conservative policy means all of the permanent current assets and part of the fluctuating current assets are financed by long term finance. G Co, what do you think about G Co? G Co currently, I have to link, is more towards More towards what? Aggressive. Okay? Okay, done. You will be able to score 2 marks. How many? 2 marks. Guys, are you with me? You will be able to score 2 marks. Done. Okay? 2 marks. Now, leave the paragraph and now advantage and drawbacks of moving towards conservative compared to aggressive for GCO's working capital requirement. Very simple, very easy, very easy. Okay. If you use conservative approach more, which means long-term finance will be used more. Yes or no? Okay. Using, please, conservative policy, G company will positive. Tell me the positive. Will use long-term finance more, which will provide them what? More, which will be less risky for them, as there will be no risk of on-demand repayment or renewal risk, which pertains to short-term finance like come on, overdraft. Business will have more security. Agreed, everyone? Okay? Security. Will have more security as long-term loans will not require quick repayment. Simple. The advantage is what? Come on, tell me. Not saying anything. The advantage is security. Security. You don't have to be stressed about repayment, on-demand repayment. Okay? Hence, liquidity position will be more stronger for G company. Hello? Done. How I'm using the points of short and long term as positive and negatives. Is this a positive point? Is this the advantage for G company? What are you saying, everyone? Can you hear me? I can't see your response in the chat box. available, active. Clear? Okay. 3 marks for mentioning the positives of conservative policy over aggressive. Over aggressive. You have to compare with aggressive. You have to compare with aggressive. Yeah, I'm comparing with short-term source of finance. Now, negative. However, the problem is the cost of long-term finance, which is more expensive than short-term finance. What is the verb? The verb is explain, explain, explain. Go into the details. Tell them why this is a drawback. Tell them why this is a positive point. Just mentioning this is not enough. Tell them why. Okay? Okay? In case of short term source of finance, the interest rate is lower compared to long term, as the investor will require higher return to compensate for the time, for the longer time the investment will be used. The cash will be used. Time, simple. Yes or no? Is that true? In case of equity finance, this is already expensive source of finance. Okay. First, I discussed about the loan aspect, interest, and now the equity part. Right? I am telling you why long-term finance is expensive. Further, more overdrafts become cheaper as they are not charging, as they are not period and fixed amount fixed time period and amount That is, the company will only pay for the amount overdrawn and for the actual time overdraft taken. Correct? If you have taken overdraft of rupees 10 for 2 months, pay for that only. Khalas. Okay? Clear? Done, everyone? So the cost is a drawback of conservative policy and risk is the positivity. Less risk is the positivity, cost is the drawback. Khalas, 3 marks for cost, 3 marks for risk, 1 mark for conservative definition, 1 mark for aggressive. Tata, bye-bye, go home. That's it. Understood? The factors that we have covered were used as a positive and negative. That's it. But because the verb was to explain, I had to go into details. I had to tell why this is an advantage, why this is a drawback, why cost is more, why risk is less. You have to go into the details of that. Okay? Clear? Understood? So for GCO, I have related in a better way with GCO. You can see the application part, how it was used, and this is done. 8 marks, simple, easy numbers of the definition, and then 3 for advantage and drawbacks. So I hope this is clear to all of you. The entire question on overtrading and working capital financing policy. Okay. Now it's time to move towards section A of the exam. Section A. Section A tips. Section A tips and tricks. Every question needs to be done in 3.6 minutes. How much? 3.6 minutes. 1.8 into 2 marks. Into 2 marks. Clear? Okay? So for section A, remember, read the requirements properly. These are isolated OTs. Rounding of instruction for fill in the blank questions are very important. Fill in the blanks. Okay? For theory based, remember, there are 3 types of statements. Number 1, out of the box. Can never be the answer. Can never be the answer. Filter it out. Number 2, distractors. They will attract you towards wrong things. they will give you the impression that, yes, I'm the answer. Catch me, take me with you. And third are angels. Angels, the correct option. So this can never be the answer. Just filter them out to make your life easier. Then it's a fight between distractor and angel. The one who has strong belief will go towards angel. The rest will go towards distractor. The one who has good concepts will go towards angel. The other will go towards distractor. So your concepts are important. Okay? So it's time to go towards section A. Here you go. Now these questions are very important. And why important? Because examiner has published these questions in the examiner report, which means whenever you see questions coming in the examiner report, it means these were horribly done. These were the difficult ones for the students. So let's see what was the problem. G company whose home currency is pound. Every risk management question, I always say to my students, find out the local currency. So it says the home currency is pound. Pound. Has received an invoice from a European supplier. The forecast annual inflation in domestic economy means pound is 5.2, while the European inflation is 2.8. Okay. The current spot rate. Now this is a one that will determine the quote. Is this direct or indirect quote? So this is an indirect quote. What is an indirect quote? A one in which foreign currency is in numerator, local currency is in denominator. So you can see it's euro per pound, euro per pound, euro per pound. And local currency is in the denominator. Pound is in denominator. So it's an indirect quote. Okay. What is expected spot rate in 6 months' time? Oh, I forgot one thing. The invoice must be settled in 3 months' time. The invoice must be settled in 3 months' time. Okay? Invoice must be settled in 3 months' time. Guys, are you with me? Okay. Now, what is the spot rate? So, what I'll use? Purchase power parity theory. Is that right? Okay. What is the formula? Spot rate into 1 plus foreign currency inflation divide by 1 plus local currency inflation. Correct? Correct? Now, foreign currency is euro. Euro 2.8%. Local currency is pound 5.2%, 5.2%. Okay. Spot rate 1.18. The problem is when you have to settle the payment. When you have to settle the payment in 3 months' time, 3 months' time, which means the rate that are given to you are annual. You have to prorate them to how many months? Can you give me an idea, everyone? You have to prorate this to how many months? We have to prorate this to how many months? Sir, we have to prorate this to 3 months. 3 months. Okay? 3 months. Come on, let's do it. Let's use the calculator for this. Let's prorate. Okay. Now, I will divide this with 12, multiply with 3. I will divide this with 12, multiply with 3. Once I do this, what I am getting here is this is 0.7%. This is 1.3%. Okay? Clear? So now what I'll write here? 1 plus 0.007 divided by 1 plus 0.13. Clear, everyone? Yes or no? Please find out the answer. Please find out the answer. Done? Okay. 0.013. And the answer is D, 1.173. Alas. So the mistake that people have done a lot in this question was, you know what? You know what? They took annual rate. They took annual rate. Stupidity. Or Numerator was denominator for someone. For someone, it was numerator. They made denominator, denominator they made numerator. So it was inverse rates that they took as well. Clear? Okay, done. Next, which of the following two government policies are consistent with objective of decreasing national growth? The reason why we didn't took 6 because payment had to be made in 3 months. Okay. So at that, what is the exact time of the cash flow? That is 3 months, right? Okay. Now, decreasing national economic growth, decreasing two policies. So let's see. This question relates to the fiscal policy, the monetary policy, right? Interest rates. Now, increasing government expenditure. This will increase the national economic growth, will not decrease it. It's part of an expansionary policy of the government, fiscal expansionary policy. Okay? Because the more government will spend, there will be more economic growth. So that's wrong. Decreasing interest rates. See, if interest rates goes down, people will borrow more. Once they borrow more, they will invest and the economic growth will go up, will go up, will go up. That is also not going to serve the declining national economic growth. Okay. In allowing domestic currency to appreciate. Hello? Yes, this is the answer. If domestic currency appreciates means what? Means what? Local currency is becoming stronger to foreign currency, which means whatever you will import will be cheaper for you. Imports will be cheaper. Imports will be cheaper for you. Okay? Which means people will import more, export less. Import more, export less. Local products demand will go down. Local product demand will go down. Because once domestic currency becomes stronger, so whatever you import, your currency is stronger. Whenever you pay in the foreign currency, your cost of import goes down. If import goes down, if import goes up, exports goes down, so the local product demand will go down. And this means imports are getting more, exports are getting less, and this will affect economic growth. People will prefer imported products only. What about the local domestic products? So economic growth, national economic growth will go down. So yes, this is the reason. Next statement, increasing taxation. If government increases taxation, yes, this will also affect the economic growth because people will have less disposable income, less income because the tax has gone up. This will affect their spending. This will affect their consumer demand. Done. However, reducing unemployment obviously is something that increases economic growth. So this increases economic growth, this increases economic growth, this increases economic growth. The two options C and D will not increase economic growth. I hope this is clear to all of you. Done. Khalas. Easy? Easy. See, filter out the wrong ones. Out of the box. Out of the box statements will never be the answer. Next. A project's predicted cash flow given a positive NPV of 35,000 at a discount rate of 7% and a negative NPV of 25,000 at a discount rate of 11%. Okay. What is IRR? To one decimal place. Fill in the blank. To one decimal place. This is one of the most easiest answer ever. I don't know why this came in the examiner report. What is the IRR formula? Lower rate, lower rate, lower rate, 7%. Higher rate, 11%. 11% minus lower rate, higher rate minus lower rate. NPV lower rate, 35,000 positive. NPV lower rate, 35% positive. By default, the sign is minus. NPV at higher rate, negative 25,000. Negative 25,000. What is the answer? Remember, this minus minus will be plus. This minus minus will be plus. Come on, what is the answer? To one decimal place. Let me work out to see what mathematical errors students can do. How much talent they need. The answer is, using scientific calculator, the answer is 9.333333333333 to one decimal place, 9.3, because the second digit after the decimal is less than 5. So we will not round up, we'll round down, because this digit, the second digit after decimal is less than 5. Simple. I don't know why people did mistake in solving this question. 9.3, 9.4, no, 9.3. It's 9.333333 to one decimal place, 9.3. I want to present answer to one decimal, which means the very next figure I will look, and if that figure is less than 5, round down, 9.3. If this would have been more than 5, I would have done it round up. Then this would have been 9.4. So answer is 9.3. If you input 9.4, khalas, wrong. Okay? Done. Next, Cyprus company is keen to use Islamic finance for funding. The board wishes to obtain equity finance, which does not entitle the capital provider to participate in the management of the company. They need equity finance. They don't need their involvement. They need equity finance, but they don't need their involvement. Islamic source, sukuk, no. Sukuk is purchasing the portion of an asset, no. Murabaha is a trade credit, no. Musharika, yes, it is equity finance. See, when I always say these two are out of the box. Musharika is a distractor, Musharika is a form of equity finance, but, but, but participation is there. Participation is there. So where is the angel? Angel is mudarba. Angel is mudarba. Out of the box. Sukuk, murabaha. Out of the box. Filter them out. Make your life simple. Get close to the answer. Musharika mudarba. Musharika mudarba. The concept says mudarba. Sleeping partner. Sleeping partner. Musharika. Both are involved into the business. And we don't need participation. I don't need participation. Mudarba. Khalas. Section A OTs. Theoretical ones. Simple. Calculative ones, rounding off. That's the strategy, man. Happy? Everyone? Happy? Say yes or no. That's the end. So we learned about section B techniques, section A techniques, CRQs, calculation, theory. Do watch my YouTube channel videos that I mentioned in day one. All those gonna be game changer for you. Happy? Share your feedbacks. Enjoyed the 2 days webinar? Say yes or no. Drafting, improved. Calculation, improved. CRQ, improved. Section A, improved. Section B, improved. Confidence, improved. Motivation, improved. No feedback? Enjoyed everyone? Happy? Okay. So guys, self-study student, you can join the revision batch. That will be helpful for you. But if you are not interested, watch my June webinar and March webinar from Wifi's YouTube channel for further clarity. Be part of the groups for further support in the last days, the free groups. And regular student, research students, revision students follow the remaining days plan that has been shared with you people. Don't be scared. Be positive. Work hard. The only thing we can do is work hard. The rest we leave to God. Thank you very much. Please share your feedback in the comment section. Do refer your friends to watch these 2 days of webinars where we have covered the latest exam questions so that they also can benefit from it. Do watch examinable verb video from Wifi's YouTube channel. Do watch Read the Marcus Mind video available on Wifi's YouTube channel. Read the Marcus Mind video for FM students. You can search on Google. You will see my video right at the top for FM. Read the Marcus Mind video. Third, do watch Smart Paper Solving Technique video from the YouTube channel. Fourth, do watch Reset Orientation video for FM for September 25 from our YouTube channel. These 4 will change your perspective. Remember to pass the paper. KPT is important. K means knowledge. P means practice. T means technique. So these videos will improve your technique. Thank you very much. See you later. These videos will be available on Wifi's YouTube channel. Best of luck. For any help, do connect with me.